Hello everybody, I'm making this video about technical analysis to clear the air about some misconceptions that have been going around this community. I'm making this for ethtrader specifically because I've learned a lot of things from a lot of smart people in this community, and as the bull season gets back into gear, I think that we're going to see a lot of newbies who don't have a lot of experience with financial markets coming in. And they're very easily influenced because when you're not confident in something is alien to you, you are much more likely to follow the herd. And the herd here seems to very loudly screech that technical analysis is pseudoscience, it is astrology, it is a scam, it doesn't work at all. And that's simply not true. I have made a metric fuck ton of money using technical analysis, and unless I just got extremely lucky and happened to make the right trades every time, then I must have been doing it right. It must be useful. So here's why I think that some of these ideas get perpetuated. People don't like to blame themselves when they lose. They like to point the finger at anything that they can find as long as they don't have to take responsibility for their mistake. And people going into trading, they might have seen a bull pennant or some shit and thought, hey man, I'm going to throw my entire bankroll at this stock and not put a stop loss because I saw a bull pennant, and then the price went down. They're like, what the fuck? Technical analysis must be a fraud. It must be completely useless, pseudoscience. And they go on Google and they see a bunch of people saying technical analysis is fake, and they see confirmation bias says, hey guys, look, see, these guys on the internet also said it was fake, so therefore I must be right. And that's just ridiculous. There are a number of reasons why the arguments for technical analysis being fake are pretty bad also. And the only way that technical analysis could be completely just garbage is if you could not discern any information from this price action and volume action to make a prediction and have it be even better than a coin toss, better than 50-50. And that's just not true. The same people that say technical analysis doesn't work are the same people that say that algorithmic trading does work. So technical analysis doesn't work, but algorithmic trading does work. Well, what is algorithmic trading really doing when you boil it down? It's taking information from the price and volume action of the market and using it to make predictions of where the price will go next. That's exactly the same thing we're doing. If technical analysis is impossible, algorithmic trading is also impossible. Because the only way that they would be impossible is if all of this information in the market was useless. It didn't tell us anything about prediction, and that's just not true. It's just so not true. Renaissance Technologies has made a 90% return or something year over year for the past 30 years using trading algorithms. I do think that trading algorithms are superior to technical analysis, but not everyone can write a fucking trading algorithm. It's extremely difficult to do. You need to be very good at math, computer science, statistics. And it's just fucking tough. TA works though. Generally speaking, it works in the larger time frames because algorithmic trading dominates the smaller time frames because computers are far faster than humans. But it works, and I can prove one of the ways that it works, and it's actually the biggest meme ever. It's the triangle. Here we have a triangle. I'm not going to count this as part of the triangle because this literally just happened while I started recording this video. But it kind of showcases the point that I'm going to make here anyways. A triangle is formed... A triangle is formed when the price action is likely to go up or down. It's likely to break out up or it's likely to break out down. It's not very likely to go sideways. Now, why is that? It is like that because of market makers. Now, there are two two types of actors in a financial market. There are makers and there are takers. The market makers are the ones that make the orders in the order book. And the market takers are the ones that fill those orders. So a market maker, what they want is for the price to bounce up and down in a nice, predictable range so that they can sell to you here and buy from you here, sell to you here and buy from you here. Every time that happens, they make this much profit. They make the range in profit. Now, the market makers want this range to go back and forth because if the price goes, if they sell to you here, and then the price goes down, they buy from you here, actually, that's not even the worst case scenario. The worst case scenario for them, it would be price goes back up, they don't sell to you, price goes down, and they buy from you. Because then they're all in. I mean, obviously they're not all in. They're smart institutional investors, and anyone with a brain will never go all in. But now they're holding this asset because they needed to hold it to sell to you. And they bought it from you here, so they're double in. And then the price goes down, they lose a fuck ton of money. So to accommodate for this volatility, this unpredictable volatility, what we're seeing right here, this whole line on the chart, here I'm going to delete this. This whole line, this is volatility. So in that event, the market makers cannot set small spreads because the spread, remember, that's the difference between the value that they're selling to you and the value at which they're buying to you, needs to be proportional to the risk that they're taking. Because if their risk is higher than the reward, they're not going to trade. So they widen the spread. This is a very wide spread at the beginning of a triangle. As the trend becomes more predictable, they will move their sell orders down and they will move their buy orders up. See, they're buying here, they're selling here. The price never got to these places, but if it did, I would imagine that they would have sold here. Until the price gets tight, like right here, and we see it's breaking out right now because of this. The market makers, once the price is this tight, this is their profit line. It's way fucking smaller than this line, notice. At some point, they're just going to leave because the volatility is always there. See, right now, the price is going up. If they had gone short here and long here, they would have got fucked. A market maker would have got fucked. So they just leave. And once the market makers leave, they're the ones that are putting down the 10,000 Ether sell orders here, the 10,000 Ether buy orders here. That's why the price can't leave this range. Once they leave, price is free to go wherever the fuck it wants. It'll go here, but it's probably not going to stay here because there's no market makers corralling it in. So that's pretty much all I wanted to talk about, guys. Triangles, it's a fucking meme, but you can actually prove, you can actually, it's one of the few things that you actually know the cause of. And obviously the price does not go up because there's a triangle. The price does not go down because there's a triangle. In fact, I'm going to put this back on. I predicted before I was making this video, I know it's kind of fucking going to seem like Captain Hindsight now that it's breaking up right now, but that the price would go up out of this triangle. Why? It's not because this is just a triangle, therefore the price is going to go up. I believe the price is going to go up because of the broader context. If I switch to the day time frame, I mean, you guys, most of you have been here through the past year. Price is fucking tanked, and we're finally bottoming out, and we're finally getting some impulse. There's a big spike in volume here with a big green candle. We're going up, and when a range tightens and the trend is reversed and it's this low, it's very likely that the price is going to go up, not down. Excuse me. Now, a triangle, you can prove how a triangle works. There's probably some other shit you can prove. I don't know what it actually means, but there's things like fib retracements that they just fucking work. I don't know why. Like you see, fib retracement usually goes to 0.618. If you had bought here, you were in very good shape. It all actually almost went to this level. Usually doesn't make it here, but I usually buy my retracements at 0.618. I don't know why divergences work. You can see there's actually a divergence in this chart. So I was not online while this happened, unfortunately, but this was a very obvious trade in hindsight because I've been away from the trading game. The volatility just has not been here recently, and this was the return of the volatility. We see this is a divergence. It's one of the most reliable signals you can get. So how I would trade this is I would see higher high. Notice how these peaks are getting higher, but these peaks in the MACD are getting lower. So this is a divergence. What you want to see to continue this trend is this peak being somewhere up here, higher than this peak. Now, because of this, we can anticipate a price reversal. So what we're going to do is draw a fib retracement. And actually, you would have seen this, you would have spotted this around this area because the peak doesn't form until the price goes down. So we had a little pennant forming in here. You see it right. You would have spotted this here around $175, and then you would have taken this retracement and bought 156, 175 to 156. That is $20 that you would have made, and that's pretty reliable. I would have started buying in here though. Honestly, I might have even started buying in here. I would have bought probably about a quarter of what I sold back in here, bought another quarter, and then bought 50% back in here. Because we're just so low right now, it would just fucking suck to get left in the dust at this stage in a cycle. Like, in the broader context of things, we're still at 170, and I believe that Ether will go over $1,000 again. I am a fucking Ethereum maximalist. I invest in Ethereum for fundamental reasons, but I trade it for technical reasons. And all the profits I make from trading, I invest into more ETH because I'm a fucking madman. Anyways, just want to talk about that. Technical analysis is not bullshit. Please, if you're new to trading, check it out. If you want to trade. If you want to just hodl, go ahead and fucking hodl. But don't be the guy that hodls and checks the price every day, because that's just going to give you anxiety. Volatility gives holders anxiety, and it gives traders opportunity. So take advantage of the volatility, or don't. Just don't be a fucking mindless hodler that checks the price every day. It's just gonna fucking take years off your life, man. If you're not gonna trade, if you're not gonna at least make money off your stress, if you're not making money off the stress, just don't let it into your life. That's my advice for you if you're new here. Yeah, so that's it. I'm probably gonna make more videos like this in the future. Yeah, see you guys around.